Hello YouTube and welcome back to another video. Today we're going to be checking in and seeing what happened to our gap because we were asking whether or not it was going to hold. And today we're a little bit unsure because the market is closing down by 68 cents. It's not all that bad considering where we started. We were down by, I believe, 2 and 2.5% overnight between the S&P and the NASDAQ. So we can note here that we do have a bullish engulfing candle. That's the first thing I want to talk about today. A bullish engulfing candle just means that we took out the range from the previous day. It formed a lower low and a higher high. So what does that mean? We ate or took out the range from yesterday. And we can note here that in after hours, we're right around that area and it's right around 375. So it still appears to me like option sellers are in control. So what drove the market today? Again, Jerome Powell gave testimony day one. So what we talked about yesterday was that there was going to be a tone set, and that tone, which is going to get set, is likely going to feed through to tomorrow when he gives his second day of testimony. So obviously, as we look here, again, we can note that we were down 2%, and then going into his prepared remarks, we actually rallied up, opened up pretty much a lot less bad than we were overnight. And now we can note, again, how were other news outlets actually framing what Jerome did today? Again, from Bloomberg, right? Powell sees ongoing Fed hikes needed to tame hot inflation. Fed aims to avoid recession, but says it's possible. Wall Street gains led defensive after Powell remarks. Dow and S&P bounce after Powell says Fed isn't trying to provoke a recession. A Fed will decide on rate hike meeting by meeting. Stocks rise as Powell's seen as less hawkish. So does that help explain what happened today? Because the fear is not really advancing all that much. Powell's definitely still hawkish, but it is perceived hawkishness that I think is actually the focus for today. So as we look here to the chart, what's important is that we've now filled one gap. So the gap going back to June 16th is now filled because we have a high here of 370.94 and our low today is 370.18, which means that this hole right here is now filled. So what we can do is actually go here and remove the yellow box to show that that gap has now been filled. However, from where we were in pre-market, and let's actually zoom in here to actually show what's happening. So we can just look here. Let's go to extended trading hours. We can note that, we actually started at 367. Oh man, that's like a lot lower than where we actually open in the cash market. Yes, it is. So now we're going to look back at that daily chart and just understand that, again, even though we opened at 367, it was fast and furious going into the open. They pumped it up really hard. So in pre-market, technically we did fill the gap here to 369.38, but as the cash market opened at 9:30, we opened at 370.6, pushed down to 370.18 and held it, which means there's still roughly an 80-cent gap left. For me, gaps get filled in the cash market, which happens between 9:30 and 4 o'clock. So here, there's still a gap left. We also have upper gaps here, right? Starting at about 385 going up to 390, and then about 395 going up to 402. So even though we have a bullish engulfing candle and Powell is less hawkish, is anyone convinced? It doesn't really look like it. Why? Volume still kind of stinks. We have to note that summer debt generally does have lower volume. It's called the summer doldrums, but not really seeing very much conviction here. So we're going to look at the options chain right now just to see whether or not there was a reason. And again, who actually won the fight today? Because it's interesting to see who actually won. So we're closing here at roughly 374.5. After hours, we're at 375. So it looks like everything here got burnt. So they burned everything here on the call side, right? So that means that a couple got paid out, right? 374s, 373s, but all the fattest stacks all got obliterated. Over here on the put side, by closing at 374, everything here basically from 375 lower got burned. But there was actually some payout today. We have to keep in mind too that because all this premium got burnt, it can help to smooth out the losses that the market makers have by paying out the 375 to 377 puts, which were in the money at the close. So these ones here pretty much paid out. 378, 379 as well. But where was max pain? I would probably say it was around 375, 376. So it's actually pretty impressive that they're able to walk it all the way down from the 2% move we were down at the open pre-market to 1% up on the day, and then all the way back to a nothing burger, right? Man, these guys are pretty good. Yep, that's why they're called market makers. They make the market. Looking here to Friday, and the reason why this Friday one is particularly important, I'll actually switch to the chart here for a moment because we know that, okay, well, we have a bullish engulfing candle, but we actually technically closed red. We closed higher than we opened, so WTF, right? What is going on, right? WTF. Are the bulls in control? Whoa, BU or BE. And yes, I know my writing is completely terrible today. I don't know. So because we are post-OPEX and generally speaking, we can see some funky action. What we want to do now is actually zoom out to have a look at our weekly chart to see whether or not there is anything here that gives us evidence that we are either tilting bullish or tilting bearish. That stupid falling wedge that provided what? A false breakout because we weren't supposed to lose this area. So there's our falling wedge identified by the blue lines. We're clearly pointing down. And what I am personally noticing before we look at the Friday chain is, again, I did this before I started recording, so I know what I'm looking for. But for the benefit of the audience, what I'm going to try to show here is just that, again, I'm splitting hairs here. Yes, I understand. I'm not touching the wick. It's more of a judgment call than making sure it's just a perfect line. So looking here, what I'm noticing is that we're still in the falling wedge. Every time before when we hit the upper trend line, right? Rejected, 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 false breakout. Well, what are we trying to do? Well, we're trying the same thing again here that we failed at all year. And man, we got some red weeks here. So if that's the reason why we're kind of stalling out and we gave back a lot of the gains into the close plus options, is there anything we have to be aware of here? Well, again, dominant volume is still what? It's red. So if the dominant volume is red, who's in control? Well, the bears, right? The BEs, right? Why? Well, red volume, red price action, below the averages, red volume. We're still off the 200 MA, which is pretty much my, if this gets lost, it's pretty much lights out for the bulls. However, if we now remove all this, what we have to kind of think about is, again, is my mouse working here? Oh, there we go. Sorry about that. My computer's been giving me some grief lately where since the Apple updates have been having some action here. Hopefully it's still recording, says it is. All right, anyways, let's go forward. So we know that leading into this week, the bears were significantly more motivated to keep wanting us to go down than before. So as I look at the chart here, there's something very obvious to me. It's this low right here, which is why we have the red line. So the red line identifies the 380.54 low. This is notable to me because even though an SPY it does not look like we actually tested it, if we look at another index, another security, meaning ES, we're going to note that we actually already tested it. I want to point out the reason why. So on Friday, we had a dividend for $1.5 that was issued. So on S&P, 1.6 divided by 375, that's roughly a 0.5% dividend that was issued. That's important because we note 374.3 is the price for, let's actually go over here. Let's look at my ES tracking and we can look here and just note that S&P is at 374, SPX is at 3759, basically 376. Over here for ES, right, ES1, which converted on Monday, is now actually 376. That's a lot higher than 374 for SPY. And as we look here, the reason why this is so interesting is because we pretty much got a test to what? 3807.5. That's where we get that 380.54 area. So if you're only tracking SPY, you're probably missing part of the picture here because this actually already got tested. Again, dividend on SPY is going to make the price lower, and then SPX and ES are actually higher. So where S&P rejected today makes perfect sense to me because we got within $2 on a $3,800 stock. So if we understand that, and now we go back here to SPY, we look at our weekly chart. Oh, I get it. So technically, Justin, what you're kind of telling me is that we kind of already did get a test here at 380.5. It just did not happen on SPY. That is correct because this is what? It's an ETF. SPX is going to be the index, and then the ES is going to be the futures. So this is an ETF, an exchange-traded fund. It is not the index. It is not the most important thing. It's just what most people track because, again, it's the most liquid one we got. So the high here at 378.72 perfectly corresponds with a test of 380.5. So what I'm trying to point out is that even though we're currently inside a falling wedge, the volume is bearish, but we have an inside bar, and we actually technically have a test of that 380.5. So now, what does that tell you? Well, it tells you that if we're finally going to stop going down, we're trying, keyword there being trying to build up pressure. And as that pressure gets built up, if we actually crack it on SPY, which means ES is now going to be roughly 0.5% above there, it's probably going to start to squeeze. from this low at roughly 380 to potentially up to 410, which would what? Fill all of our daily gaps, which we have all the way up here to roughly 402. And again, flipping back to here, to our other board, what would that be? That'd be a perfect gap fill all the way up to our highest gap at 401.44. And we would actually even get a 50 DMA test. Oh man, wouldn't that be something? I think it would. So now as we look here to the options chain and we understand what the weekly chart is telling us, now we want to see whether or not there is evidence that the bulls or bears are more motivated than the other. And I'm putting this out on purpose because, again, we've been going down for what? It's been how many weeks here? I think it's like 10 out of 12 weeks we've been red, right? So 10 divided by 12, it's like 80%, something like that. 83% of the last 12 weeks we've been red, right? I'm tired of this. I want to go back up. And if we now look and see who was motivated, we're going to get a little bit of a preview here. So option sellers were in control today. Tomorrow is the only non-expiry day. And then on Friday, the 24th, we're going to have the weekly chain expiring. So as I look forward to here, whoa. I'm noticing the what? 380 versus 370. First thing that sticks out again. Why? Big volume, big open interest, and a big round number. So is there a spread or not really? It looks like it's just naked buying. Over on the put side, it does look like there is a volume to match it at 375 or a continuation from today. So what this tells me is that 375 is still what? The area of max pain going into Friday. Why? Everything here on the put side gets burnt. Everything below this green line, burnt. Everything above 375, burnt. So it's really interesting that people are still going above $5 out. They're not going at the money. They're going out of the money. So that's the first thing that's notable to me. And again, they roughly seem equally motivated, but those silly bears just keep on buying more and more and more. And now as I look forward to the July expiry, which is going to be July 15th, I'm looking here to see whether or not we can glean a little bit more. Yes, we can. So what do we have here? What is this? I didn't even notice this earlier. It just came up actually into the close. That looks like a straddle to me. Someone's building a straddle at 380, which means they think it's going to move 20 bucks. So 380 plus 20 is what? 400. 380 minus 20 is what? 360. Okay. So that's the first time we've seen a straddle in a while. Next thing I want to note is that other than that, there are basically no calls, which means there is very little bullish motivation past Friday. There's very little motivation going into the next month. And as we look over here to the put side, what is there? There's continuation. And again, over here, we looked at this chain yesterday. There's now plus 9K over here. So this was 99,999, and now it's 108.7. So it means there's been roughly 9,000 added to the 370 strike for July 15th. Then we note that there's also volume at 375 with open interest. So at least to me, it seems like the bears wanted to let the bulls think like they had control. Why? They get to buy more puts. And then on the call side, again, it looks like it was all about just burning the premium for today. So what I want to really see going into Friday, because tomorrow is the only non-OPEX day, is what happens on the daily bar. Because now we have a bullish engulfing candle, which means we need immediate continuation if we're going to go up. And final thing is that I think a lot of people have been reluctant to unwind the bear positions they initiated, notably during these 2 weeks right here. So during these 2 weeks, they initiated a whole bunch of shorts. And if that's the case, if we now get back above 380.54, what's going to happen? They're going to start losing money. They're going to be at from green to red. So that is where we can have what? A squeeze. Because what I've noticed, again, what I pointed out is that the chain is neutral going into Friday. 375, pretty much where we are right now, is going to be max pain. However, going into next month, the bears are still significantly more motivated than the bulls. So what that's going to tell me is that people are fighting this. They don't want it back higher. They don't want those daily gap fills. And if that's the case, and they're reluctant to cover, and we notice they stomp the close, if, again, keyword here being if, we can get above the 380.54, I think that we could start a squeeze. And from the beginning of the video, again, we noticed the gap at 401, the 50 DMA at 408, and if we're going to get there, this is the recipe. If you're interested in watching more in terms of how I got prepared for this week ahead, there'll be a video that queues up here in a moment. Otherwise, thank you very much for watching, and I look forward to seeing you tomorrow. Thank you.